Welcome, everyone. So glad you're able to join us for the latest California sales tax trends and forecast webinar, economic trends webinar. Just by way of introduction, I'm Bobby Young, Client Services Director here at HdL, and I'm joined today by Brett Plumley and Tracy Vesley, both fellow principals here at HdL. All three of us work on the team that meet with clients every quarter to go through your sales tax results and tell you where all the money came from, and then cross our fingers, as we'll be talking a lot about coming up here with regards to the forecast, where it's going to come from in the future. So hopefully we'll be looking forward to seeing you guys over the next couple of months, along with the rest of our team. Added little plug for HdL and who we are. We've been proud to serve communities, local communities, for over 38 years. We're working on 39. Next year, we'll be celebrating our 40th, so that's here on the horizon. We are so blessed to have a 99% client retention rate. So thankful to have you as clients and hopefully provide you with valuable information as we go. All right, so let's just go ahead and get started here. 2Q results and kind of what happened. The second quarter, April, May, June sales period, as you see on the screen here, right down at the bottom, total 10% jump this quarter. Nice double-digit gain, continuing that trend. I think now we're about 8 quarters of double-digit gains since the pandemic periods. So very strong results during second quarter. And what you see here on the screen also, for the 2Q, the two industries that had the most dramatic percentage gains. Fuel and service stations, positive 43% gain statewide, and restaurants and hotels, up 18%. Both of these shouldn't really surprise us too much. Obviously, we've been following the trend, especially on fuel and service stations, which Brett will be talking about here in the next couple of slides. But the 40% gain over on the restaurant side, also not much of a surprise there. 18% gain. We've seen higher menu prices and that demand to eat out. So we'll be talking most notably about those two categories coming up. To the far right here, you'll see also the regions, the major regions throughout the state where we saw the most dramatic gains and rebound. The Bay Area and Southern California regions. This is a continual reminder that these were the two areas, the two regions that were so dramatically impacted by the pandemic. We're seeing that continual rebounding growth, but it is definitely softening. And when you look down below, other regions that had been experiencing double-digit gains now into very solid single-digit growth. Far north, quite a different dynamic there. They didn't fall off quite as much as during the pandemic, and so the rebounds weren't necessarily as strong of a gain. So they're just down about 2%. As we look fiscal year 21-22, so for many agencies that run a July to June fiscal year, the end of the second quarter or with the second quarter data fills out the entire fiscal year. So kind of a flashback, if you will, just to see what happened during fiscal year 21-22. Overall, statewide, strong, extremely strong, 15% gain. Again, this is now the second full fiscal year of double-digit gains. And why many, when you were wrapping up, as you're wrapping up your year end, you're looking at your numbers and going, wow, this is extremely strong, right? And we were talking about this as we've been forecasting 22-23. These double-digit gains, okay, now it's time to start rethinking or not getting used to them. As you'll see in our forecast, we do anticipate some cooling off. The three big categories, like with 2Q, both fuel and service stations, restaurants, contributed heavily for the fiscal year. Also at the very top, you'll see autos transportation, extremely strong, 13% gain. Hopefully we've touched very tightly on that for throughout the fiscal year with you and your results. But that too is a category that will start to get some rethinking, if you will. Statewide, by region, you can see most regions experience those double-digit gains that we have been talking about all along. And let's get ready because I think most of us have an idea of what's going to be happening coming up. So that's a real quick recap of the results. And again, over these next few slides, we'll go into much greater depths and details to walk through the 2Q results. when we're thinking about the forecast, when our team got together and kind of mashed our heads to figure out and shine up our crystal ball, these were definitely some of the major topics that we're looking at and talking about. Obviously, on everybody's mind are interest rates and what the Fed has been doing most recently, and how is that going to in turn impact the economy. Also, included with very much a big part of the 2Q results and the double-digit gain has been inflation and higher prices that we've been paying. Obviously, that's been leading to the Feds raising interest rates as a result. Russia-Ukraine crisis still impacting, with 2Q results, definitely impacting fuel results. But as we go forward, even through the summer and coming winter periods, how is that crisis going to be trending when it comes to global crude oil prices? Brett will be talking about that here very quickly. Wages have been a constant steady. As prices have gotten higher, employees demanding more wages, giving more money to spend, which again, kind of really helps the overall cycle for sales tax growth. Really think about the future. We sit around and think about the future of wages and how consumers will either be helped or hurt as we continue to move along. And then also supply chain, not as big of an issue that we sat around the table and really thought about compared to, let's say, maybe a year ago from this time period, September, October, as we started getting ready for the holidays, right? We had heard about ports being extremely busy. Not as much. That's definitely loosened up, which, as we've heard from a lot of different merchants, that they don't anticipate as much of a supply issue. Now it's about consumers willing to buy and able to buy all of the goods that they have. Feds and interest rates. Let's just jump right in, see it for what it is. Down here at the bottom, March 17th, 2012 was when the Feds started to raise rates. And this is just that recap of how very quickly the Feds have responded to inflationary concerns, to, I think I may have even mentioned it during the last webinar, but kind of punch us as consumers in the face a little bit, tell us to stop buying as much so quickly, right? Because that was also contributing to supply chain issues, thereby raising prices. So I think the message has definitely been heard by consumers that yes, the Feds have jumped right in. It's about a total almost 300 basis point increase since March. And with the September meeting was the last one for the 2022 calendar year. So the Feds won't reconvene until 2023. So we can take a deep breath now. And obviously it leads into, okay, what are the Feds going to do at the beginning of the 23 calendar year? And how is that going to impact the economy? Hopefully I'll be touching on that, what our vision is or what we see happening later on here in the forecast. But this is just kind of that quick recap on inflation. The other thing, just from a general economic perspective that we've been looking at, is definitely savings versus disposable income, or this net gap in between these two lines here. Really now starting to tighten up. No surprise, as consumers continue to spend all the way through the first part of 2022. Now it's starting to get tighter again. Using a little bit more of the savings to pay bills. This is probably one that we're watching very closely as we move towards the normal holiday shopping season. A lot of people end up financing those purchases. Interest rates going up can make it a little bit more expensive, or do they just pull money out of savings and pay and avoid finance charges? So some of those concerns are definitely ones that we've walked through during this forecast season. Let's see, there we go. And then looking at statewide local tax, this is just kind of, while we don't always look back or keep a strong tally of kind of CPI adjusted data, this was just one as the conversation continues around how much inflation has gone up, just to really solidify that for us, whether it be local tax. As it is, you can see the dramatic growth post-pandemic. Remember also that we had new money from marketplace facilitators out-of-state marketplace facilitators, so new sales tax revenue that definitely helped boost that up. But then once we do adjust for CPI, what does it look like? And it's very, very soft. You can see otherwise fairly what some might consider nominal growth from the height back before the Great Recession. So again, we don't overly focus on CPI, adjusting for CPI, because we really do then want to forecast based off of what's going to come into your coffers. But this is just a nice chart that we thought would be interesting to show. So results, as you see here, middle of the screen, 2Q in the red box, saw 10.1% growth. And as I may mention, while we only show here, going back into the 1Q21 period, all double-digit gains up till this point. And then you start to look at the forecast and what we've got, what we think is going to be happening coming up. 3Q on a statewide basis, again, overall, up about 8%. And we're right here at the end of September, which is the end of the third quarter period, third quarter sales period. So we think the economy is still going to be strong. Gas prices were still elevated. Restaurants, especially with the great weather that we've had, expected to continue that part of the story. Other things, maybe like autos, as Brett will be talking about, would probably cool off just a tad. Fourth quarter, still expecting about a 5% gain, but then here's really where we think consumers are going to start to question purchases post holiday, really reevaluate. Feds will reconvene. As of now, fully expecting the Feds to touch interest rates again at the start of 23, and thereby have a little bit more of a lasting effect, right? And so the other reason for staying on this chart for a little while is to really walk through or visually demonstrate the difference on the fiscal years and how, when we see at the very end, what will look like a very strong percentage for fiscal year 22-23 has a lot to do with what our thinking is for the end here of the calendar year 22, the start of the 22-23 year, because we most certainly are building in some slowing down of growth overall going forward. And really here to the far right, you see where both the back end of 23 and 24 starts to take a little bit more of effect with the slowdown. So again, we'll see that as both Brett and Tracy talk today, you're going to see more of this reflected in each industry's forecast, and then also the fiscal year end when I get there. Breaking apart local place of sale from the total, and you'll see here local place of sale was up 10.6, and so all the businesses are located locally. And then overall, we ended up going down to 10.1, and that has more to do with what Tracy will be talking about and the pools and pool growth not being quite as strong as overall what we saw local place of sale. As you can imagine, and I'm sure as Tracy will mention, as consumers have been back in stores, maybe buying a little bit less than they did a year ago online, so thereby growth softening from the pools. But still here to the far right, you'll see that overall the percentage changes are definitely softening up and even negative through certain periods locally. At this time, I'll turn it over to Brett to jump in with autos. Go ahead and take it away, Brett.
Thank you, Bobby. We're going to start talking about each of the major industry groups in more detail at this point. We're mainly focusing in on second quarter 22 and the future. Starting here, auto prices. And within the autos and transportation sector, prices have been telling the story in terms of sales tax growing. Overall, second quarter 22, autos and transportation was up 5.2%. And the prices continue to be at record levels and climbing, but this growth is slowing. So year over year growth slowed in this second quarter 22 to 13.4% above the same period a year ago. The last quarter, when we talked about the prices compared to the year earlier, they were up 22%. So definitely starting to see a slowing down of the growth. Buyers continue to pay well above MSRP, and incentives are at historically low rates. In terms of trends, we are seeing notable trends within the industry. On the left side, they're trending up. The prices of trucks, luxury vehicles, and now inventory, it's still low, but it is beginning to recover. So that's a part of the story now. On the downside, trending lower are vehicle registrations, small cars, as opposed to luxury and SUVs and fleet cars. And then on the right side of the screen here, we're looking at new light vehicle registrations, and we've now seen 3 consecutive quarters of double-digit decreases in light vehicle registration. In terms of the market share, we are seeing double-digit declines in vehicle registrations overall, but look at the luxury and sports vehicles and luxury SUVs. They are continuing to gain market share, and we've seen and been talking about this trend over the last several quarters. So that's part of the story again here, helping to drive the overall sales tax up. The forecast is, I mentioned 5.2% actual results in the second quarter of 22, and really close to our projected 4%. What I want to highlight here, we've got third quarter 22. Bobby had mentioned positive performance throughout the state and statewide forecast, a little more than 8%, and that's pretty comparable when we're talking about autos and transportation. We're anticipating one more really solid quarter of growth at 8%. And then you can see flattening out beginning late 22, early 23. That's the theme throughout most of the major industry groups that we're talking about today. And then in autos and transportation in all of fiscal year 23-24, look at that drop. We now are showing a 3% reduction happening. And that is going to be happening throughout most of the major industry groups as well. Medium-term outlook is more subdued within the autos and transportation, and the factors that are causing that include the increasing financing rates, a decelerating economy, losses in financial assets, and pointing to a potential downturn in the next year in autos and transportation. I mentioned one more very positive level of growth in 8%, and then 22-23 fiscal year is up 4.5%. And we're going to, outside of that 23-24 top of 3%, we're then back to more normalized annual levels of growth, 3% all the way out to fiscal year 27-28. Fuel and service stations, Bobby talked about the factors that are impacting this sector right now. This one, we talk about fuel consumption. U.S. crude oil production expected to set a record in 2023, forecasted at 12.6 million barrels per day. And what this chart is showing here is consumption is continuing to be expecting increase all the way through calendar year 2023. That's what we wanted to show you with this chart. In terms of the crude oil prices, back a quarter ago, the forecast expected the barrel prices to remain above $100 all the way to the end of 2022. And that has changed now, coming back down. Prices actually dropped in August to $93, even more in the month of September that we're in right now. And that has caused the EIA to lower their outlook through 2024. The drop in barrel prices late in second quarter and early third quarter 22 is putting downward pressure on the pump prices and the sales tax associated now. So we're still talking about growth, but a little bit slower growth than what we were talking about 1 quarter ago. This one shows the crude oil prices, and at a national level, crude oil prices determine at least half the price of each gallon of gas. For every $10 in oil barrel prices, that translates to roughly a quarter increase in the prices at the pump. We still had record levels of both pump prices and oil barrel prices in this quarter that we're talking about, but toward the end of it and on into third quarter 22 that we're living in right now, we've started to see drops. You're feeling that as a consumer. The prices have dropped down lower at the pump, and that's going to start translating to lower sales tax. We're still not seeing that yet. In terms of the overall forecast, we had projected 50%. The actual came in at about 43% in the quarter. And we are seeing a little bit lower increase in third quarter and fourth quarter 22 than we did one quarter ago, 35%, 15%. And then look at that calendar year 2023, the theme that we're talking about today and that Tracy will talking about in a moment with the other major industry groups, a reduction overall in calendar year 23, and crude oil and pump prices steadily dropping. Demand for fuel is expected to be lower in calendar year 2023. Federal Reserve, as they continue, as Bobby mentioned, to increase interest rates to curb inflation, that is definitely going to have an impact. And overall, 22-23 continue to be positive growth in this sector, 8.8%, and then followed by a reduction of almost 8% in fiscal year 23-24, zero growth in this sector in 24-25, and then normal annualized growth of 2% all the way out through fiscal year 27-28. So the picture is starting to change here. Building and construction, this sector had another positive performance in this quarter. We had projected 8.5%. The actual came out at 8%. And overall, permit valuations, prices of materials, including lumber, are up compared to a year ago. Lumber is starting to drop at this point. But this is having an upward pressure on the sales tax generated in this sector, especially in the quarter that we're talking about, second quarter 22. With higher mortgage rates, owners are continuing to remain focused on home renovations and projects around the home. So that's going to help the do-it-yourself type of businesses like Home Depot and Lowe's that we talked about early on during the pandemic. And we've still seen some positive performance after the pandemic. And that is the trend that is continuing on for another quarter or so. The outlook here is for 2 more solid quarters of growth through the end of this calendar year, and then followed by sales impacts from lower material prices, and that's going to drive down the overall sales. The overall growth in 22-23 is projected at 3.1%. And then when we look again, the common theme in fiscal year 23-24 in this sector, consistent with most of the other sectors, we've got only 1% growth in all of fiscal year 23-24. So you can see as we head into 23-24 in this sector, really beginning to flatten out. And then normal annual growth is expected to return in fiscal year 24-25. And that is projected at 4.5% annually, with 5% growth all the way out to 27-28. The prices of inputs here, we wanted to talk about this. This chart is provided by the National Association of Home Builders. It shows how residential construction material prices are trending. I mentioned lumber prices. They were in decline most of the second quarter, and they picked up a little more than 2% in July. And other material prices that have an impact on especially building materials, that type within building and construction, they include gypsum, steel milled products, concrete. They've been trending upward, and this is causing upward pressure on the sales tax received when we combine that with the strong demand that we continue to see in the second quarter. Now we're going to talk about restaurants and hotels, that sector. And this particular chart is talking about food at home or away from home. The red line that you see here represents the food services and drinking establishments, and that is that's actually the black line. It's above the red line there, and that's continuing to grow and above pre-pandemic levels at this point in time. What you see in the red line is food and beverage from stores, and that's actually dropping a little bit and flattening out. So we wanted to show you that trend. Other trends that we've talked about in past quarters are pretty comparable at this point. And what we're seeing here, labor shortages, the trend is improving. Last quarter, the restaurants were understaffed by 70%, and now they're only about 50% understaffed. So that's improving. Food delivery, we talk about Uber Eats and the solid performance throughout the state, and especially how that's impacted the pools. Forbes is indicating that that is here to stay. So we're going to continue to see that trend as we move forward in this sector. The California Restaurant Association was successful in getting beer and wine to be permanently allowed to be delivered, and they're also continuing to work on cocktails. So that's a change that looks like it permanently has come out of the pandemic and helping overall that industry, restaurants and hotels. Menu prices, in terms of inflationary impact on this sector, the trend is up 7% to 9%. And the demand, again, in this quarter in restaurants and hotel sector is solid. So that's having a positive impact on the sales tax generated overall here. In terms of the forecast for restaurants and hotels, we had projected 10%, and the actual came out even better than that at 18.3%. Hotels and leisure entertainment continuing to see more demand. So at this point, every business type within the restaurants and hotel sector has completely recovered and then some above the pre-pandemic levels. The projection that we have here is for 2 more quarters of solid growth through the end. You can see here through the end of calendar year 22, 9% growth. And then fiscal year 23, 24, as well as out years all the way out to 27, 28, more normal levels of growth at 3%. So this sector continues to do well. Food and drugs has been a very stable sector all the way going back to the beginning of the pandemic. Actually did really well during the pandemic with grocery stores and drugstores and cannabis-related businesses doing so well. This is the smallest sector, as we continue to remind you, throughout the state, bigger in some cities than in others, but very solid, very stable. 2% is what we have projected. The actual in this quarter, 1.4% growth. And we're looking at modest overall improved sales, better numbers from grocery and drugstores, and that helped it make up for declines from the cannabis-related businesses and those retailers. Really, we saw those plateauing the sales several quarters ago throughout the state. So we've seen saturation that has taken place. Food costs have definitely been impacted by the inflation situation, and anticipated gains we will be seeing for the foreseeable future. So 2% growth here, continuing in our forecast all the way out to fiscal year 27, 28. And with that, I will hand it over to Tracy.
Right. Well, thank you very much, Brett. Okay, I am going to focus on outcomes and projections for 3 primary tax groups, which are all pretty well related to one another: general consumer goods, the countywide pools, and the business and industry group. Let me forward the slide and I will get started. So looking at the slide, the general consumer goods group has 28 individual categories. The slide is representing the top 10 by dollars, and they represent about 90% of the group's local tax. The graph looks at the results for the second quarter, which are the blue lines, and the results for fiscal year 21-22, which are the green bars. 21-22 ended 13.4% above the prior year. So a big growth, big cash year, pretty consistent across the state. And then for second quarter 22, it ended 3.4% above the prior year quarter, beginning to see that decline. I think if there's a theme in Bobby's and Brett's and my conversation today, it's we're slowing down. And this graph is really designed to show how the growth in all these major categories in the general consumer goods group is beginning to slow down compared to the fiscal year results. A couple of highlights: discount department stores where are you? Right here. They show it shows a 10% increase, but that is really being bolstered by fuel. If you pull out the fuel, that growth is really closer to about 2.5%. So again, slowing down compared to those fiscal year results. Family apparel and department stores in here, also seeing some decline. You really see it in department stores here. The growth in the second quarter, almost non-existent compared to the fiscal year results. So again, slowing down. Family apparel discount department stores and department stores showing some clear differences in how income groups are being, how they're reacting to the higher prices caused by inflation. Some retailers that cater to lower or middle income groups are seeing a contraction in their revenues versus luxury brands that continue to increase. So definitely some differences there. Categories that focus on durable goods like home furnishings, we really are starting to see, and this is where that is, we're starting to see a contraction compared to the fiscal year results. This category, and as were a couple of others, like for example, sporting goods and bike stores, really pulled forward during the pandemic. Now we're kind of leveling off, recovering from our retail hangover during the pandemic and going back to levels that I would say are a little bit more normal, but starting to show some contraction moving forward. So general consumer goods, what are retailers and economists saying? They're actually saying very similar things. Retailers are seeing a weaker demand for the discretionary categories of spending. They're seeing profits driven by food and beverage in some of the retail establishments. These are non-taxable items in many instances, so they're seeing the profit there. We're not seeing it on the sales tax side. Retailers are expecting to really reduce prices during the heavy shopping period toward the end of the calendar year. And beauty, and I'll say the one category that is holding strong is the beauty category. We are still spending money on beauty products, but overall, the confidence in consumer spending and personal finances is waning. Economists are saying the same thing. So from an economist perspective, the outlook is generally weak. It varies by industry group, of course, and we'll be, Brett touched upon a few. I'm going to be hitting a few myself. Each group is a little bit different, but there's a general slowdown. Expecting weak sales as spending trends towards services instead of goods. That's part of the story here. As we have recovered from the pandemic, we're a little bit more into services than we are into buying stuff. And then there's the interest rates. So policymakers continue to try to curb inflation by increasing interest rates, slowing down demand. That's having an impact, obviously, on how we spend our money, and consumers are stretching their spending. We are saving less and using more credit, neither of which is necessarily a good thing going into the future. Looking at the future for general consumer goods, the top bar of this graph displays the year-over-year percentage quarterly change. And then the line graph does the same thing, but just from a different perspective. So for second quarter of 22, the actual result was 3.4% growth over the prior year. We projected 2.4%, so fairly close to what we had anticipated. Consumer spending was fairly resilient in the second quarter, even despite inflationary pressures and the federal policy actions. But again, we're starting to see that shift in household spending, and retailers are seeing a demand shift to non-durable goods, which again is looking more at services, less at stuff. And also looking at that heavily discounted retail period or shopping period during the end of the year. Prices are driving the positive sales tax proceeds to a large degree. So inflation is having an impact on the results. Higher prices, more dollars. Sales volumes are starting to go down. HdL expects modest growth in taxable sales in the fiscal year 22-23. We can see, calendar year, fiscal year 21-22 is pretty strong. We start to slow things down, specifically in the fourth quarter period here. Fourth quarter of 22, we bring it down to 1% growth. And then for almost all of calendar year 23, we are in negative growth territory for the general consumer goods. Now, we have to remember we're launching off of big growth in the prior periods. So this negative growth is really an adjustment down. We do not anticipate growing at that level that we had previously. Okay, let's take a look at the countywide pools. These results are pretty similar to what we saw last quarter. And this graph is highlighting the top tax groups that contribute into the pools. Business and industry and general consumer goods are the two primary groups, with autos and transportation kind of following in third place. A lot of that driven by transactions at the Department of Motor Vehicles. So the biggest growth in this group right here is business and industry, and it was up 15%. This is, again, very similar to what we saw last quarter when we talked last quarter. A lot of this growth is the infusion of capital into certain sectors such as energy, medical biotechnology, and the electrical equipment group. Some of these energy and electrical equipment specifically related to big projects throughout the state, generally considered one time. So we're going to see a few quarters of cash coming in and then it'll level off. Medical biotech as a group really pushed forward by the pandemic. We just have not seen that spending subside yet, anticipating it to do so in upcoming quarters. Then general consumer goods, which is a huge part of the countywide pools, this is basically all of the online sales, was relatively flat for second quarter. It actually declined 0.2%. And again, in large part, as consumers faced higher prices and shifted spending to food and services, a little less spending on stuff. Unique pool revenue trend that I just wanted to highlight, and I think Brett brought this up as well. Many is food delivery companies. So many food delivery companies have opted to be considered marketplace facilitators, which means for deliveries, the restaurants are not considered the place of business. And the marketplace facilitators, therefore, are reporting their local tax through the pools. So that is certainly different than what we've seen in the past and emerged through the pandemic as we're all stuck at home. So countywide pools trends looking into the future. This graph displays the performance of the general consumer goods group, which is the blue line, and the business and industry group, which is the gray line. Kind of goes back to third quarter of 2018 all the way up to second quarter of 22. General consumer goods, as we can see, kind of starting right here, has bolted and become the dominant group, at least for the better part of the last 2 to 3 years, contributing to the countywide pools. So definitely an internet sales infusion. Fourth quarter 19 through fourth quarter of 20, we see the impacts of AB 147 as all that out-of-state online sales tax now can come in and be collected. And also with that is the Marketplace Facilitator Act. So those third-party affiliates on many of these big platforms now must collect and remit sales tax. So that's all new revenue to California that we had not seen previously. So we see that as part of this big trajectory here. And then coupled with that is our frenzied spending during the pandemic. That is what drove this increase in the pools. And then we see this big drop. So that's two things. One of them is cyclical. It's normal to have a first quarter decline after the fourth quarter, big shopping season. And then the other part of this, and it's something we've talked about over the last year and a half, is the shift of some revenues out of the pools into direct allocation, which we'll see that when we talk about the business and industry group in just a moment. All right, and then, so as expected, we are just really seeing this growth level off. We're now at a new baseline with the pools as that revenue is shifted out, and really looking at a more moderate growth going forward. And then with the general consumer or the business and industry group here, very, very moderate growth as well. But continuing, they used to be a little bit ahead of the general consumer goods group. Now they're just a solid performer. The two are starting to meet each other in their growth patterns. All right. So looking at business and industry group, I've talked about it a little bit. These are the 6 major business types that are propelling the indirect tax receipts within the business and industry group, reporting 18% growth in the second quarter of 22. So it's medical and biotech, it's the light and heavy industry, business services, which is business to business, office equipment, also business to business, and electrical equipment. So those are really the big 6 groups that are driving the business and industry revenues within the countywide pools. Okay, so the forecast for the pools. We saw this big ramp up here throughout the pandemic, a little bit of leveling off when some of those revenues shifted, but still continuing to grow. The second quarter results came in at about 8%. They came in at 8%. We had forecasted growth of 5%. So we're still seeing that growth pretty heavily here. Forecasting going into third quarter of 22 and fourth quarter of 22 at about 6%, still anticipating some of those projects in the business and industry group to continue, and general consumer goods online spending to continue as well, just albeit not at the same level as in previous quarters. And then really leveling off to a 4 and 5% growth in the out quarters. All right, let's shift over to the business and industry group. A lot of this will be repetitive. We've talked a lot about business and industry as we're discussing the pools. A lot of the same trends will be reflected in this group as well. Fulfillment centers now are the largest business type in the business and industry group. This is due to that shift of revenues out of the pools into direct allocation, and also driven just by basic online sales. So if we look at, this group as a whole is about a quarter, I think I said this, about a quarter of the total revenues for the entire business and industry group. Grew about 6% in the second quarter of 22. So you can see the dramatic growth here, kind of fourth quarter 19 through fourth quarter 20. This is the result of AB 147, the reporting by marketplace facilitators, and our pandemic spending. Very, very similar to what we just discussed related to the pools. And then here you see there's another big growth period. And this is first quarter 21 through fourth quarter 21. And this marks that structural reporting shift from indirect to direct allocation for some revenues that used to go into the pools. And this really launched the fulfillment centers into the forefront of this category, of the business and industry category. Future quarters are a little more modest in their growth now that we have a new baseline of revenues. We saw, again, 6% growth in the second quarter results. This slide is just looking at the top business types within the business and industry group, pulling out the fulfillment centers, knowing they're already 25%. The group itself has 21 different business types. They're pretty diverse. They range from industrial equipment, farm, agriculture, all the way to wineries and motion pictures. So you can see it's a really diverse group of business types. These are the top business types, all of which grew in the second quarter results. The only group that we saw contraction in was in the garden and agricultural group, in part attributed to the fact that a year ago in first quarter of 21, there was a big infusion of cash through the various stimulus programs, including PPP, that allowed a lot of businesses to go out and buy equipment in this sector, not seeing that same level of purchasing in the second quarter results. Looking at the business and industry forecast, pretty moderate growth going forward. We projected for the second quarter results 5.3% growth. It came in at 7%. Really looking at that leveling off going forward. Third quarter coming in at closer to 5%, and 4% and 3% in these out years. Again, for second quarter, almost all of the 21 business types grew during that period. So at this point, I'm going to hand it over to Bobby to wrap up.
Great. Thank you, Tracy, and great job, both Tracy and Brett, carrying us all the way through the major industry groups. And so coming back into kind of that, the summary, right? Bringing it all back together, everything that we've talked about today, really now putting it on a fiscal year basis, you could see 22, 23, why we still have, think back also why we still have the 4% growth there. It's the very strong, what we still see, maybe not strong, but solid all the way through the end of the calendar year, only then starting to temper off at the beginning of 23. That's where you then see us really cool off the entire fiscal year, 23, 24. Has a lot to do, obviously, with the cumulative effect of higher interest rates, consumers shifting around. Also, as you heard Brett and both Tracy talk about, because of general consumer goods, fuel prices either coming down or even just leveling off. We won't expect to see dramatic growth like we have over the last 2 fiscal years. So when looking at these percentage changes, really consider, and kind of why we put these webinars on is to allow you, give you as much information as possible to apply it locally. Obviously, pretty much everybody has adopted their fiscal year budgets back in June, and the economy continues to shift around a little bit. Kind of think through the demographics of your local agency and how you might be able to apply, hopefully, a lot of the information that we gave you and how we're then forecasting. How does this 4.1, as we've talked about the dynamic changes in the economy because of interest rate hikes, because of consumer demand, how does this 4.1 compare to maybe even about 9 months ago, right before we started updating annual budgets for all of our clients? The 4.1 is actually a little bit higher. At that time, we were thinking 22, 23 would come in at about 3.6%. So how, if we all have anxiety or potential anxiety over our forecasts, 22, 23 could be a little bit stronger, again, because of the back end of the calendar year. How does 23, 24 compare? We were anticipating the slowdown. We had it only at 2.9 compared to the 3.6, right? So we were cooling it off, but now you can see we've got it down to 0.7%. So much slower growth, still growth, just much slower than what we've seen. And I think I've made this comment many a time that in response to the, okay, when's the recession coming? When's the next recession coming? And for a lot of clients, it's a direct correlation. Recession equals lower revenues, right? Decreases in revenues. Here you can see on a statewide basis, this cooling off means, okay, revenues may not really go down, They might stay a little bit closer to flat, but when expenditures are still increasing as costs get more expensive, then it's going to feel like a recession because you've got one half the ledger that's going off the charts when the revenues aren't really keeping up pace, right? And so that's when the feeling of recession is likely to kind of set in. So, and then you can see in the out years a return to normal historical growth at this point. I say this maybe a little bit more confidently or a little assuredly that as quickly as the feds have raised interest rates to respond to inflationary concerns and higher consumer prices, is the likelihood they will start decreasing interest rates to re-stimulate or kind of get back into a normal growth cycle once they've smacked us around a little bit as consumers. And thereby starting 24, 25 is okay, start to see more normalized growth in the out years. So if anybody's starting in on their longer range projection, we see this a little bit more short term, not a lasting impact on our economy. And again, I think we sit here more with the thought that the feds will respond and our government, our federal government, will respond as necessary, given how sensitive everything is around the economy. So those are the wrap up from a technical percentage basis. Just a few bullet points here, hopefully to summarize everything that we've spoken about. Local tax receipts for the entire fiscal year 21-22 were up dramatically. You've all seen it. We've been talking about it for such a long time. There are headwinds that are on the horizon. Hopefully, we've starting to include those, take those into consideration with our forecast. And consumers, where will consumers be? Maybe not so much leading up to the holidays, but turn the calendar year, where are consumer thoughts going to be? Really do hold us down. So our short term is just moderate growth for 22-23, and then a more notable slowdown into 23-24. Thank you all so much for joining us today. It's a privilege to be able to provide you with all the information that we end up kind of geeking out on every time we get it to see what happened. We definitely look forward to seeing you on video over the next 2 months, October, November, meeting with all of our clients, going through what happened in 2Q. Keep in mind, again, while there's potential dynamic changes in the economy, we really do want to try to get in the third quarter results, which is the period that you're receiving cash right now, really be able to analyze all of that to then update your forecasts. By default, we'll be updating all the forecasts starting the next quarter. Once we get 3Q data in December, we'll be meeting with you in January and February and updating your annual forecast for the current year and for future years. It will likely reflect a lot of what we've been talking about here today, but we really kind of want to see what happened in the third quarter, because as we've talked about both restaurants, fuel, thereby leading over to general consumer goods, we're still expecting to see some summer tourism money come in and hopefully have a very solid third quarter. In the meantime, stay safe, and I hope everybody has a great rest of the day. Thank you so much.